5 devastating financial crises, all within the last century. And every single one was completely different.
Completely.
You had the Great Depression in 1929, which was this ultimate deflationary collapse. Stocks just gone, down nearly 90%.
And then you fast forward to the 70s and you get the exact opposite problem, stagflation. Inflation just gutted bonds, it destroyed savings.
Then 2008 hits, a credit freeze, a systemic failure, totally different animal.
Yeah.
Followed by the COVID crash in 2020, which was, the fastest panic in history.
And just when you think you've seen it all, 2022 comes along and delivers this nightmare scenario, an uncommon twin crash. Both growth stocks and, the traditional safety net, long-term bonds, they just plummeted together because interest rates were surging.
5 unique disasters.
Mm-hmm.
5 totally different causes. But here's the thing. The pattern for how you survive them, it was identical.
It's identical. And that's the core of what we're digging into here.
Right. Most people, most portfolios, they're built for just one kind of world. A perfect world. Perpetual growth, cheap credit, low interest rates forever.
A glass portfolio, basically, built for sunshine.
Exactly. And when that world changes, when the macroeconomic state flips to deflation or inflation or a credit freeze or a rate shock, that single-angled assumption, it always collapses.
Always.
So today, we're going to look at the actual blueprint for resilience. We're unpacking the simple, maybe even boring truth that survival is the most reliable path to building real generational wealth.
We are going to map out the roles of just 3 core positions. That's it. Cash or T-bills, gold, and S&P 500 equities. We'll look at how they preserved capital and created options across every single one of those disasters we mentioned.
And we'll compare the 2 most famous all-season strategies, Harry Brown's permanent portfolio and Ray Dalio's all-weather.
And critically, we have to confront the behavioral traps, the fear and the greed that can sabotage even the most perfectly engineered plan.
Let's start with just the sheer range of these shocks, because I think the number one lesson here is that you absolutely cannot predict what the next crisis will look like.
You can't.
You can only know the one is coming eventually.
Mm-hmm.
And it's probably going to be something you haven't specifically prepared for.
Well, and that unpredictable range is, frankly, terrifying to the traditional investor. Let's take the Great Depression, kicking off in 1929. This wasn't a recession.
No.
It was the ultimate deflationary collapse. Asset prices didn't just fall, they evaporated. The stock market, from its peak to the bottom, lost roughly 89% of its value.
89%.
So if your entire portfolio was just built on stocks, you were wiped out, not for a year or two, potentially for decades. It was a catastrophic liquidity crisis where all the purchasing power suddenly shifted from paper assets to cold, hard cash.
And so the key to surviving that specific disaster wasn't, bravely buying the dip on the way down.
No, that would have crushed you.
It was holding that anchor. Position number 1, cash.
Precisely. During the Depression, T-bills, that's short-term government debt, were paying about 3 to 4% interest. Now, crucially, consumer prices were falling off a cliff. That's deflation, sometimes at, 6 or even 10% a year.
So your money is earning a little, and everything you can buy with it is getting cheaper.
Exactly. When you combine that positive nominal return with rapidly falling prices, the real return on your T-bills was massive. Some estimates put it at 28 to 30% over that period. Cash didn't just survive, it gained immense purchasing power.
A dollar suddenly bought way more goods, more land, more companies than it ever had before.
Right. But then, just a few decades later, the whole game flips. The macroeconomic threat does a complete 180, and the thing that saved you, cash, becomes a liability.
You're talking about the 1970s, stagflation.
The opposite crisis, inflationary destruction. It was kicked off by the Nixon shock, which completely decoupled the dollar from gold. Then you had high government spending, oil shocks, and inflation just surged into the double digits.
So now the asset that saved you in 1929, your cash and your savings accounts,
is actively destructive. It's losing purchasing power every single day because the price of gas, food, everything is just surging. And long-term bonds, which are super sensitive to inflation, they were absolutely gutted.
And this really shines a light on the big vulnerability of the traditional 60-40 portfolio, right?
Yeah.
60% stocks, 40% bonds. It relies on stocks for growth and bonds for that deflationary safety.
But when the environment shifts to high inflation and low growth stagflation, that portfolio is caught completely exposed. It has no defense.
And if we fast forward again, 2008 was a totally different beast.
A fundamentally different beast. It was a credit freeze, a systemic failure that was rooted in all these complex financial instruments. It showed that even if you had a globally diversified portfolio, if it relied on easy credit, everything could implode at once. It revealed this hidden correlation risk across everything.
And 2020 was just speed, a flash crash, the fastest 35% drop in history. It was pure liquidity panic.
But the recovery was just as fast. And it was driven by this unprecedented monetary and fiscal stimulus, a fire hose of money.
So that taught us that modern crises can have this dual personality.
Yeah.
A violent deflationary shock followed almost immediately by a massive inflationary injection of capital.
Which brings us to 2022, an environment that just defied all the classical diversification strategies. Investors got hit by that twin crash.
Right. Normally when stocks fall because people are scared of a recession, central banks cut interest rates, and that makes long-term bonds rally. They act as a hedge.
But in 2022, central banks were doing opposite. They were raising rates aggressively to fight inflation.
And that crushed the bonds.
It crushed the bonds right alongside the growth stocks. So your classic 60-40 portfolio offered zero meaningful protection. The correlation between stocks and bonds flipped, and everything was sinking together.
It's just so clear that building a portfolio for only one environment like low interest rates and endless growth it's fundamentally irresponsible risk management.
It is. I mean, the core problem is that if you have to sell during a crisis to cover your expenses, or if your entire portfolio is just tied up in these falling assets, you have zero optionality.
You're trapped.
That's the key insight here. Surviving a crisis, it isn't glamorous, it's not exciting, but survival plus time equals generational wealth. The dry powder, the cash, is what turns a market crash from a devastating event into a once-in-a-decade buying opportunity.
Okay, so since we can't predict which type of crisis is coming next, we have to build a strategy that works in all the fundamental environments. We need to simplify this incredibly complex global economy into, 3 key states that dictate how assets perform.
Precisely. The whole goal of the 3-position portfolio is to pick one asset that does best in each of those states. And if you do that, you basically neutralize the need to be a brilliant macroeconomic predictor.
All right, let's define them. State 1. Deflation or crisis collapse. This is your 1929 scenario, or the deepest, darkest part of 2008. Asset prices are falling, confidence is shattered, liquidity is gone. What's the priority here?
Capital preservation and maximizing your real purchasing power. The best assets are the ones that hold their nominal value or even go up in real value as general prices are falling. This is the domain of, low short-term government debt.
Okay. State 2. Inflation or currency debasement. Think the 1970s. The purchasing power of your paper money is just eroding fast because of fiscal or monetary excess.
In that state, you need insurance. You need a hard asset, something that cannot be printed, that can't be digitized, that can't be manipulated by central banks. It's insurance against the instability of fiat currency and the government's, let's say, creative responses to huge debt burdens.
And finally, state 3. Growth or recovery. The sun is shining, the economy is expanding, corporate profits are compounding, productivity is increasing.
This is the wealth engine. This is the asset that performs poorly in the other 2 states, but over the long run, it is the only vehicle that systematically grows your capital faster than inflation. It allows for genuine compounding.
So the genius of the strategy is that by holding all 3, you guarantee that at least one part of your portfolio is doing its job, no matter if the world is collapsing, inflating, or growing.
That's it. You're always protected.
Let's break down these 3 simple assets. And we have to start with the one that's the most counterintuitive for so many investors, because we're all taught to hate sitting in cash.
Yes. Position 1 is cash, but specifically we mean treasury bills, T-bills. Its primary role is to protect you against deflation and liquidity crises. That's state 1.
So why T-bills specifically, and why is this so different from just holding cash in your regular checking account at the bank?
Well, T-bills are short-term government debt. They usually mature within a few weeks, up to a year. They are backed by the full faith and credit of the U.S. government, which makes them the most liquid and safest asset in the world.
And crucially, they pay interest.
Crucially, in the current environment, they're paying, 4 or 5%. A zero-yield bank account is passive. It's lazy money. T-bills are active cash. They're providing you a return while sitting in the safest place possible.
And as we talked about with 1929, that small nominal return, when you combine it with deflation, can create spectacular real returns.
Exactly. But the value of T-bills isn't just about deflation protection. It's about liquidity during a freeze. And that is the definition of optionality.
The ability to act.
The ability to act when everyone else is paralyzed. When the 2008 crisis hit, credit froze. The entire system just seized up. Everybody ran to safety and they piled into T-bills, pushing the yields to almost zero because the demand was so high. But the people who already held T-bills, they had the capital to make moves.
We always hear about Warren Buffett and his immense cash pile. Right now, Berkshire Hathaway is holding something like $325 billion in cash and T-bills. That's about 30% of their total assets.
It's a massive position.
So is that purely for crash readiness? Or is it also because he just doesn't see any compelling investment opportunities at today's, euphoric valuations?
I think that's a critical question, and the answer is almost certainly both. Holding T-bills serves two purposes: capital preservation and readiness. If you think current assets are overvalued, euphoria, which we'll get to, then holding cash limits your downside while you earn a safe yield.
But the key is that readiness.
The key is readiness, because when the crisis hits and prices drop 30, 50, 70%, Buffett used his cash in 2008 to deploy tens of billions into bargains. Goldman Sachs, GE. He fundamentally altered the trajectory of his company with those deals.
And the same concept applies to high-level tactical moves. I'm thinking of Bill Ackman's famous trade during the COVID crash.
Yes, Ackman famously used his dry powder. He bought $2.6 billion worth of credit default swaps, or CDS. You can think of them just as insurance against corporate debt defaulting.
So he was betting on a crash.
He was. And when the market crashed, that insurance paid out billions. It generated immediate, highly liquid cash. And he then immediately took that liquidity and plowed it into crushed stocks like Starbucks and Hilton, buying them at 40 to 50% discounts.
Without that optionality, that dry powder, that generational opportunity is just gone.
It's gone. T-bills give you that foundational power, but without the complexity of trading credit default swaps.
So position one is our shield. It's against liquidity risk and deflation, and it generates cash flow while preserving our purchasing power.
Precisely. Which brings us to position two.
Gold.
Position two is gold. This is your insurance against inflation and currency debasement state two. It is the ultimate hard asset. It cannot be printed. It cannot be digitally created. And it has a 5,000-year history as a store of value.
Okay, but I have to challenge this because a lot of critics will say gold is just a useless relic. It's a volatile rock, it doesn't pay you anything, and it can sit flat for a decade while the S&P 500 is compounding like crazy. If we already have cash to fight deflation, why do we need this specific type of insurance?
That's a fair critique, and it really gets to the core philosophical difference between gold and other assets. Gold's purpose is not to yield. Its purpose is to protect you against scenarios where government credibility fails. Its performance is counter-cyclical to the stability of fiat currency.
So it's a bet against the system, in a way.
It is. Look at the 1970s. The context matters. When President Nixon ended the convertibility of the US dollar to gold in 1971, inflation was just unleashed. That entire decade saw massive government debt and huge growth in the money supply.
And that's the environment that led to that explosive, 24x gain?
Exactly. Gold started that decade at $35 an ounce. By 1980, it rocketed to $850 an ounce. This wasn't a growth story. It was a monetary hedge.
So while your paper assets and your savings accounts were getting destroyed by double-digit inflation,
gold preserved and multiplied wealth. The physical asset didn't change, but the dollar's value relative to it just completely collapsed.
And this protection extends to deliberate government actions too, right? Like the devaluation in 1934.
Correct. When FDR revalued gold from about $20 to $35 an ounce, anyone who was holding physical gold saw an immediate 69% overnight gain in dollar terms. The gold position acts as this critical hedge against systemic risk and monetary debasement when governments choose to inflate their way out of debt.
And right now, we're seeing a massive flashing signal from the global financial system that suggests a deep distrust in long-term fiat stability.
This is one of the most compelling data points for gold today. Global central banks, we're talking China, Russia, India, Poland, Turkey. They have bought over 1,000 tons of gold annually for 3 straight years, from 2022 through 2024.
Wow.
This is the highest 3-year total since 2010. Central banks, the very institutions that print the currency, are actively signaling their concern over unsustainable global debt. They're diversifying out of sovereign debt and into hard, non-printable assets.
When governments stop trusting other government bonds, you should probably pay attention.
You should pay attention.
So in terms of how you actually do this, we need to be clear. We're talking about the pure asset.
Absolutely. We're looking for that insurance hedge. So you should focus on physical gold, or more practically, ETFs that hold allocated physical bullion, things like GLD or IAU. You want to avoid leveraged gold mining stocks.
What is that? They can offer much higher returns.
They can, but they introduce firm-specific risk. Mining strikes, environmental disasters, bad management. Gold's role here is simple insurance and capital preservation. It's not for aggressive leveraged speculation.
Okay, so that brings us to position 3, the engine.
The engine. S&P 500 equities. This is the long-term growth and compounding engine that thrives in state 3. It represents ownership in the 500 largest, most dynamic, most productive companies in the U.S.
This position is just.
Yeah.
It's non-negotiable for long-term investors, isn't it?
It is. Despite all the spectacular crashes and crises and depressions we've just talked about, the S&P 500 has delivered roughly 10% annual returns for over a century. It systematically grows real wealth.
But let's be brutally honest about the volatility. It can fall 30, 40, even 50% in a single year. How do we justify that level of risk?
The justification is entirely in the time horizon, that volatility is the price of admission for superior long-term returns.
You have to be able to stomach the drops.
You do. While the S&P can deliver catastrophic losses in the short term, if you look at any 15-year period in its history, it has never delivered a negative return. It always recovers, and it always reaches new highs. It reflects the enduring productivity and innovation of the U.S. economy.
Let's use 2008 as a concrete example.
Yeah.
The S&P 500 fell 57% from its peak to its trough in 2009. That feels like an eternity when you're in it.
Yeah.
How quickly did it actually recover?
If you held on through the absolute bottom, which was in March of 2009, the S&P was back to its previous high by March of 2013.
4 years.
4 years. And while 4 years feels incredibly long when you're living through it, in the context of a 30 or 40-year investing career, that recovery period is actually pretty short.
So the real risk of the S&P is that you might need the money when it's down.
That's the risk. And that's the job of position 1 and position 2, the cash and the gold. Their job is to ensure you never, ever have to liquidate position 3 at a loss.
So if the S&P is the compounding machine, the first 2 positions are basically insurance against your own emotions. Insurance against the risk of selling at the worst possible time.
Absolutely. The S&P captures the highest probability bet on sustained growth. The T-bills in gold protect your sanity and your capital during the downturns. They make sure you have the emotional and financial capacity to stick with the growth engine until it recovers.
So we have the 3 core roles. Now let's look at how expert strategists actually built full portfolios around these concepts. We're comparing the 2 most famous structures built for this. Harry Brown's Permanent Portfolio, or HPB, and Ray Dalio's All-Weather Portfolio, AWP.
Harry Brown's design is just the definition of simplicity and structural elegance. It's completely non-predictive. It uses 4 distinct asset classes, and it weights them all equally, 25% each.
Okay, let's nail down that configuration, because it includes a crucial 4th leg we haven't really focused on yet.
Right. So HPB is 25% U.S. stocks, like an S&P 500 index fund, 25% gold bullion, 25% cash in U.S. Treasury bills, and 25% long-term U.S. Treasury bonds.
So we have our 3 positions, plus this big chunk of long-term bonds. What is the specific job of that long-term bond segment?
That long-term bond piece is explicitly designed as a hedge against severe deflationary crises, the kind where interest rates are falling rapidly towards zero.
Like 1929.
Exactly like 1929. Prices were falling, and the Federal Reserve eventually cut rates aggressively. Long-term bonds are highly sensitive to rate cuts, they have high duration, so they surge in price. They perform beautifully when the economy is collapsing, and that provides a strong counterbalance to your stocks, which are collapsing at the same time.
So the 2FIN252525 structure guarantees that one part of your portfolio is working well, whether you're in prosperity, inflation, recession, or deflation.
That's the elegant idea behind it.
Now let's contrast that balanced approach with the traditional 60-40 portfolio, especially after what we saw in 2022.
The 60-40 is really only built for 2 scenarios: high growth and low inflation, where your stocks do well, or deflation, where your bonds do well. It is profoundly vulnerable to inflationary stagnation, like we saw in the 70s, where both your growth assets and your bonds failed.
And it failed again in 2022.
It failed again in 2022 when rising rates just crushed the bond component. The HPB, by including gold for inflation and cash for liquidity and rate shocks, is just far more resilient across all those different regimes.
And the risk metrics for the HPB are often cited as being superior, largely because of that heavy cash allocation.
That's right. If you look at the comparative risk metrics historically, the HPB consistently delivers better risk-adjusted returns. It has slightly lower volatility, about 7.19% versus 7.68% for the all-weather, and a significantly smaller maximum drawdown.
So it doesn't fall as far in a crash.
Exactly. It had a max drawdown of about negative 15.6% versus almost negative 20% for the all-weather. That dedicated 25% cash position just dampens volatility much more effectively than the commodities component that Dalio favors. It's an inherently ego-free strategy. It's simple, it's passive, you rebalance once a year, that's it.
Okay, let's talk about Ray Dalio's all-weather portfolio.
Yeah.
It is arguably the most famous risk parity strategy in the world. It's synonymous with institutional durability, but its structure is a lot more complex than the Browns.
The complexity really comes from Dalio's core philosophy, which is risk parity. You're not allocating your capital based on the dollar amount, but on the risk exposure of the asset.
What does that mean in practice?
Well, because bonds are historically much less volatile than stocks, Dalio allocates a much larger percentage of capital to bonds to get a similar percentage of risk exposure as the stocks. It's why the AWP is so bond-centric.
Let's get into the specific configuration.
It's 30% in the U.S. total stock market, 40% in long-term treasuries, 15% in intermediate-term treasuries, 7.5% in gold, and 7.5% in commodities.
So that's 55% dedicated just to bonds and treasury instruments.
55%. It has a bit more equity exposure than the permanent portfolio, 30 versus 25%, and it replaces that big cash allocation from HPB with a smaller slice for commodities.
And that commodity slice is the key difference.
It is. Commodities like oil or industrial metals are generally excellent inflation fighters. Sometimes they can even outperform gold during periods of intense commodity-driven inflation. However, they also add a lot of complexity and volatility, which is why the AWP tends to have slightly higher volatility and deeper drawdowns than the HPB.
But when you compare their long-term track records, the results are surprisingly close, aren't they?
They're nearly identical, which is fascinating. Historically, the compounded annual growth rate, the CAGR, for both portfolios is right around 5.63%. The AWP might give you marginally higher returns over the very long term because of its larger growth components, the stocks and commodities, but it accepts higher risk to get there.
So the HPB prioritizes preservation with its huge cash anchor, while the AWP is trying to optimize returns through leveraged bond duration and commodity exposure.
And that means it accepts a slightly bigger bump during periods of bond distress, like what we saw in 2022.
But ultimately, both structures prove the same point. Spreading your risk across those three fundamental market states, growth, deflation, inflation, is a superior strategy to the single-minded 60-40.
Absolutely.
Okay, so having the perfect recipe means nothing if your own psychology forces you to burn the meal. Let's get into the technical frameworks and the behavioral pitfalls that professional analysts use to manage risk and, more importantly, manage themselves.
Well, when we quantify risk, we have to move beyond just thinking about simple loss. We use volatility, which is represented by the Greek letter sigma. It's the standard deviation of returns.
So it's a statistical measure of observed risk, how much an asset's price has fluctuated from its average return in the past.
Exactly. It's backward looking. And this observed risk is often confused with implied risk, which is where the VIX comes in.
Right. The VIX is the volatility index.
It's fundamentally different. The VIX is a statistical measure of implied volatility. It's derived from the price of S&P 500 options, and it reflects the market's collective expectation of future risk over the next 30 days.
So one is measuring past movement, the other is measuring future fear.
That's a perfect way to put it. When the VIX spikes, it means the market expects extreme turbulence soon.
So how do we know if our diversification is actually working? How do we know if we're not just holding a bunch of different highly volatile assets that are all going to go down at the same time?
That's where the Sharpe ratio is invaluable. The Sharpe ratio quantifies the reward, your excess return that you're getting for each unit of risk or volatility that you had to endure. It shows you the tangible value of diversifying your positions.
So a portfolio with high returns, but also super high volatility, might actually have a worse at ratio than a portfolio with slightly lower returns, but much, much lower volatility.
Exactly. It's a key metric for risk-adjusted performance.
But you mentioned it has a drawback.
It does. A drawback is that the Sharpe ratio treats all volatility equally. It doesn't distinguish between upside volatility and downside volatility. So a massive unexpected surge in profit will actually hurt your Sharpe ratio just as much as a massive drop. But for broad portfolio comparison, especially for strategies like these, it's a necessary tool.
Let's talk more about diversification, because the source material is really clear. It reduces risk, but not in the way most people think.
Right. Most people assume diversification means you won't lose money, which is false. The main benefit is reducing your total portfolio volatility by combining assets that don't move in lockstep. It primarily reduces what we call firm-specific risk, the risk that a single company you're invested in goes bust.
And the power of that volatility reduction hinges entirely on one concept:
correlation.
Correlation measures the relationship between the price movements of two assets. The success of the permanent portfolio relies on intentionally combining assets with low or negative correlation.
So things that don't move together.
Or that move in opposite directions. For example, when your S&P 500 stocks are soaring during a growth period, your T-bills and gold might be flat or even falling. But when those stocks are collapsing during a deflationary crisis, your T-bills hold their value and your long-term bonds soar. Let's look at the source data on that. When you combine assets with low correlation, the example given is combining Facebook, a tech growth company, with ExxonMobil, an old economy energy stock, with a correlation near 0.1. The portfolio's standard deviation, its risk, drops dramatically below the average of their individual risks.
That's the engine of risk management. By combining the S&P 500, which historically has low or negative correlation with gold and T-bills during times of stress, you're mathematically reducing your overall portfolio volatility.
Yeah.
It isn't magic, it's just statistics. You're creating a portfolio that is constantly being buffered by the part of it that is in favor during that specific market regime.
But no amount of technical analysis can save an investor who is gripped by fear or greed. The sources highlight that retail timing mistakes have historically shaved decades of returns from the average investor's outcome.
This is why you have to have an explicit mechanical plan to counter your natural behavioral biases. The core behavioral mistake is chasing the highest short-term returns.
The fear of missing out.
Exactly. If your balanced portfolio is returning, say, 5.5%, while some single tech sector is returning 30%, the emotional pressure to abandon your discipline and pile into that hot asset is almost overwhelming.
And that pressure just increases exponentially as the market cycles through a bubble. We have to be able to recognize the stages to maintain our perspective.
Understanding the 5 stages of a market bubble is crucial. It starts with displacement. A new technology or event shifts everyone's focus. Then credit creation, cheap money fuels speculation. Then comes euphoria, widespread acceptance, FOMO. This time it's different. Then the critical stage prices peak and the smart money starts to exit. And finally, the debubbling or deflationary period, the crash.
So based on the source analysis of U.S. corporate financials, where are we now?
Based on analyzing recent trends, specifically rising U.S. corporate liabilities and slow U.S. corporate real GDP growth, the data indicates the market stage is currently signaling euphoria.
And euphoria is the most dangerous stage. It's the belief that the trajectory is permanent, that prices will only go up. How do rising corporate liabilities and slow real GDP growth statistically point to this euphoric stage?
Well, when your real underlying economic growth, your GDP, is slow, but corporate debt and liabilities are aggressively increasing, it suggests that the returns you're seeing aren't being fueled by genuine productivity gains. They're being fueled by financial engineering, easy credit, and speculation.
So the sugar high.
It's a debt-fueled expansion, which is characteristic of a late-stage bubble. Leverage is being maximized right before the critical stage. Now, recognizing this is not a call to sell everything, but it is a crucial trigger to double down on your risk management, on rebalancing, and on increasing your position one, your PASH, and T-bills.
So while the strategy is long-term, some technical tools can help with tactical risk control. Let's talk about momentum.
Momentum is simply the tendency of assets that have been performing well to continue performing well, and vice versa. Momentum trading tends to hold winners longer than losers, which actually provides an inherent tax efficiency compared to, say, deep value investing that requires frequent buying and selling.
So you could use momentum signals to guide your annual rebalancing.
You could. Perhaps slightly increasing the slice of the position that has the strongest momentum, as long as it doesn't violate your core allocation rules.
And for day-to-day risk management, technical analysts often use the average true range.
The average true range, or ATR, is a measure of a security's volatility against itself over a recent period. It calculates the average price range, the high minus the low that it has moved. Technical analysts use ATR strictly to help establish risk levels, like setting stop prices or position sizes.
But a crucial caution here. ATR does not predict future volatility.
It does not. If a stock's ATR is wide, it just means you need to set a wider stop price to avoid getting knocked out by natural market noise. It helps you size your bet based on the asset's current historical turbulence.
Okay, we've established the history, the 3 core positions, the behavioral traps. Now we need to translate the complexity of the permanent portfolio and the all-weather into a simple, actionable structure for the listener.
Right. The structural idea is always the same: optionality, insurance, and compounding. Now, while the HPB uses 4 positions, including those long-term bonds, we saw how vulnerable long-duration bonds are in high-rate or inflationary environments. It's what crippled the 60/40 and the AWP in 2022.
So you're suggesting a simplified 3-bucket approach.
Yes. We favor merging the stability and liquidity functions into an expanded cash and T-bill position. Prioritize optionality over that duration risk.
So we focus on the 3 core assets we defined: cash T-bills, gold, and the S&P 500. And the allocation depends entirely on your time horizon.
Let's start with the younger savers, let's say anyone under 40. They have the maximum amount of time for compounding and the ability to absorb massive volatility. Their goal is maximum growth capacity.
But we have to make sure they still hold that insurance and optionality, even if they're focused on growth.
Absolutely. So the allocations would be 20% in cash T-bills. That's your essential dry powder, earning interest, protecting you. 10% in gold. That's the non-negotiable insurance against long-term currency debasement. And 70% in the S&P 500. Maximum exposure to the compounding engine, using their long time horizon to recover from any downturn.
Now for the conservative or near-retirement investor, someone over 60. Here, stability and capital preservation are the priorities.
The focus shifts dramatically towards stability, income, and optionality. We have to increase the protective elements significantly to make sure they don't have to sell equities at a loss to fund their living expenses.
So the allocations look very different.
Very different. 40% in cash T-bills. A significantly increased cash exposure to cover living expenses for several years, provide stability against deflation, and protect against rate shocks. 10% in gold, maintaining that baseline insurance hedge, and 50% in the S&P 500. Still maintaining meaningful exposure to growth to keep pace with long-term inflation, but it's safely balanced by that dominant cash position.
The theoretical allocation is only half the battle. Execution matters, especially making sure that position 1 is truly effective cash.
For position 1, the cash and T-bills, you have to move beyond the zero-yield bank account. Buy short-term treasuries like 3-month or 6-month T-bills directly through a brokerage account. Or use a conservative money market fund that specifically holds T-bills. This is cash that is earning a market rate, offering true liquidity, and is backed by the U.S. government.
For position 2, gold, the simplest method for the average investor is a low-cost ETF.
Yes. Buy a low-cost ETF that holds allocated physical bullion. GLD or IAU are the big ones. It's the simplest way to get exposure to that pure monetary hedge without the logistical complexity of storing physical bars or coins.
And for position 3, the S&P 500, we stress simplicity and consistency.
Buy low-cost S&P 500 ETFs, SSPY, VOO, IVV, and set up automatic monthly purchases. That practice, known as dollar cost averaging or DCA, it removes the stress of trying to time the market. You're buying high, you're buying low, and you're smoothing out your average purchase price over time.
That brings up a key debate, though. When we do have a major crash and your position 1, your cash, swells from maybe 20% to 50% of your portfolio's value. Should you deploy that massive cash pile immediately, lump sum investing, or should you continue dollar cost averaging into the falling market?
That's a classic tactical question, and statistically, lump sum investing often outperforms dollar cost averaging simply because the market tends to go up more often than it goes down.
But emotionally, it's terrifying.
Emotionally, it's devastating if you deploy all your cash right before one final large leg down. So our recommendation aligns with that behavioral focus. Use a gradual redeployment strategy. If equities drop by 30%, start deploying your cash gradually in fixed tranches over the next 12 to 18 months. This combines the statistical benefit of buying at deep discounts with the psychological safety of knowing you still have dry powder if the market falls further.
And finally, maintaining the discipline. Rebalancing.
Rebalancing is the mechanical, ego-free core of this entire strategy. You rebalance annually or whenever your allocations drift in a meaningful way, say by 5% or more.
And rebalancing forces you into the counter-cyclical action that defeats your own behavioral biases.
It forces you. If equities have dominated after a long rally, you trim that gain and you redeploy that profit into the positions that are currently lagging, your cash or your gold. If your cash swells after a crash, you redeploy it into discounted equities. This is the simple action that separates disciplined compounding from panic-driven regret.
We've seen this pattern repeat for 100 years. Crises always happen, but survival is never guaranteed. The three positions, cash for optionality, gold for insurance, and the S&P 500 for compounding, it's not a strategy for aggressive bets. It's a reliable blueprint for enduring prosperity.
The emotional truth is often really harsh. The average investor identifies so closely with their portfolio that they celebrate when it's up and they panic when it's down. Building insurance into your portfolio is not cowardice. It's disciplined preservation that shields you from your own fear and greed. It ensures you have the emotional fortitude and the actual liquidity to withstand the chaos.
Because when the next bubble bursts or the next inflationary shock hits, the environment is going to be terrifying. The single big question to ask yourself each time you rebalance, especially when the market is signaling euphoria like it is now, is this. Do you want to be ready to buy assets at a steep discount when the markets crater, leveraging the cash you deliberately preserved?
Or do you want to be the person selling everything at 50% off, destroying decades of compounding in a single moment of panic? The contrast between those two positions, the buyer versus the forced seller, is the mechanical difference between compounding into generational wealth and lifelong regret. The choice is yours to make long before the panic truly begins.